So the US online gaming market continues to offer significant growth opportunities, both B2C and B2B businesses. However, recent regulatory and tax developments posing a number of challenges and complexities, both domestic and international groups, as they look to expand in the US market. So to discuss and share insights relating to a number of these challenges, I'm very pleased to be joined by specialists from BDO US and BDO UK, who'll be talking through some of the recent developments and how these are impacting businesses operating and looking to operate in the US. So let's start with some introductions. My name is Paul Daly, and I lead a UK transfer pricing practice, and I focus on the sector, and I enjoy my work with many operators and B2B providers. We're also joined by Daisy Borflower, who's a UK tax specialist who focuses on assisting gaming groups with domestic and international tax issues. So turning to my US colleagues, we have Ben White, who is one of our market leaders and a specialist tax partner focusing on the sector. We have Patrick McColgan, who leads our US transfer pricing practice for betting and gaming. We also have Ilya Lipin, who leads on state and local tax. So all of the people speaking to you today have a great deal of expertise in the sector, and we're a team who work together regularly. So I'm very pleased to be able to introduce them, and I'm looking forward to a good conversation. So if you do have any questions as we go through the session today, please drop them into the question box. I'll be keeping an eye on things, and we will have some Q&A at the end, and I will ask the questions of the panel for you. So let's head over to the agenda. This is what we will be covering today. You'll be hearing from Ben, Patrick, Daisy, and Ilya. We'll leave you with some key takeaways, and then, as said, we will deal with questions. Okay, so without further ado, I'm going to hand over to Ben. Ben, please take it away.
Great. Thank you, Paul. Welcome, everyone. I've spent half of my career in Las Vegas, which is where I learned everything that I know about the gaming industry, and I continue to work in that sector. But I thought I would start off by just giving everybody an overview of trends that I'm seeing in the US gaming industry. And you probably won't be surprised that it's digitally driven. Natalie, if you can go to the next slide, please. Okay, so the first item I wanted to point out is that internet casinos, they continued their strong growth in 22, even though there were no new states coming online in that year. The combined internet gaming revenue across the six states that have lawful online casinos reached a record of $5.02 billion, and that was up 35.3% compared to the previous year. 3 jurisdictions in particular, New Jersey, Michigan, and Pennsylvania, accounted for more than 88% of that nationwide total. Legislation was recently considered by lawmakers in at least 7 states, including Indiana, Illinois, and New York, which all are very populous and could drive that number up even higher. One item I do want to note is that internet gaming is permitted in Nevada, but it's only for poker. And so I didn't include it in these numbers. Go ahead to the next slide, please. Thank you. So now this huge growth in the regulated sports betting in the US is really fueled by the launch of mobile sports betting in New York. The US sports betting market continued to grow during the 4th full year since 2018's historic US Supreme Court ruling that permitted all states to regulate sports wagering. So the regulated US sports betting market generated a total of $7.56 billion in 22, not including sportsbook operations in tribal casinos. That total marked an increase of almost 75% on the prior year. By the end of 22, legal sports betting was available in 32 states, plus the District of Columbia, and that's a mixture of live sports betting and online sports betting. During 22, Kansas, Maine, and Massachusetts, they all passed legislation to authorize sports betting. And Kansas actually went live in September of 22, just prior to the football season. Alongside New York in 22, mobile sports betting was launched in Louisiana, in Arkansas, and in Maryland. Go ahead, Natalie, to the next one. So the next 4 slides, they're really reference for you all about the breadth of gambling types in the U.S. But I thought I would point out just a few highlights to continue showing you some trends that are happening. And like I said before, internet gaming is permitted in 7 jurisdictions, where Nevada is just limited to poker. But now contrast that with mobile sports betting, which is now it is legalized, maybe not live, but legalized in 27 jurisdictions. So land-based commercial casinos or racinos, which is just a casino attached to a racetrack, they are in 28 jurisdictions. So internet-based gaming is coming, and it is coming after them quickly. Natalie, you can go ahead and scroll through the next couple of slides so people can see that all of the states are listed out. And I pulled all this information from the American Gaming Association State of States in their report for 2022 gaming. Go ahead to the next one. And the next one. And then one more. So that's just an overview. I'll come back at the end to talk about a few other things, but now I'm going to pass it over to Patrick and Daisy.
All right, thank you, Ben. So Daisy and I are going to talk through some direct tax considerations, starting with transfer pricing. And then Daisy will cover some international tax considerations for the sector. So just moving forward, please, Natalie. So I know we have a pretty broad audience here today, so just kind of stepping back a little bit, transfer pricing in any industry is a pretty highly scrutinized part of tax law by governments, and it relates to how related parties compensate each other for the use of intellectual property, services, tangible products. And there's a lot of attention on transfer pricing to make sure that related parties are paying arm's length compensation, and it's done with a view to make sure that there's no artificial transfer of profits from one jurisdiction to another, and so each tax authority is always scrutinizing taxpayers' support for their transfer pricing to make sure that they're getting their fair share of the profit. And so when we look at the gaming industry, there are several nuances, especially with respect to the expansion to the US market, that really put even more emphasis on getting your transfer pricing right. And so, as Ben just noted, the US gaming market, obviously so much opportunity and a lot of high growth. And we have obviously a lot of homegrown companies that are looking to take advantage of the regulatory changes, but obviously, like several of you participating today, lots of very well established gaming industries from outside the US that are really looking to leverage their experience, their platforms, their technology, and really get into the US market and take advantage of all the growth opportunities. And so with that comes a lot of thoughts, and we work closely with Paul, Daisy, and their team on how do we get the right transfer pricing policies set up. And several key issues, and I think the main one of the main items which really has a outside impact on where your profits for the US market are going to end up are how you think through the platform and the intellectual property, and who is developing that in the US or non-US, and how are you compensating for the use of some of the legacy platforms that may be well developed outside the US, and how does the US, pay for that, and what type of rate? We also see, with the rapid expansion and some of the regulatory nuances of the US, that a lot of our non-US clients are doing significant development efforts here in the US to either adjust their platform or create regional specific content. And so, thinking through, who is the economic owner of that activity, US or the traditional non-US principal or owner of the legacy IP, is a key area where we spend a lot of time with our clients to make sure that we're being very thoughtful. And along this vein, we also see, a lot of acquisition activity, sometimes just for content with gaming studios, or sometimes for particular pieces of platform IP, and kind of thinking through how we acquire that, who is the owner, and have we got the right pricing for the IP, which can be a significant portion of the revenue that the third party revenue that we're going to record here in the US. So it's a key area to get right, and I know a lot of our clients and us put a lot of thought into this. So third item here, management headquarters support. And so typically, we've got very well established executive teams outside the US. We're also, our clients are ramping up local executive teams here on the ground in the US. And so thinking through the intercompany service charges, and who does what and for which country is an important area. And I think one key area, a focal point, and we touch on, obviously later on we'll touch on tax authority scrutiny on this sector, with respect to some of our inbound clients here that have established headquarters outside. Some of those headquarters may be in really strong regulatory geographic regions that also sometimes can be viewed as sometimes tax beneficial. But obviously, one of the key areas that we emphasize with our putting support together for that is really well how established the substance that we have in a lot of those hubs that are outside the non-US region. And so really being clear on management headquarters support, how you acquire the IP, and how we're treating the platform, some of the key areas here. And finally, in terms of key transactions, the sales and marketing, and again, going back to the competitive nature, the competitive market here in the US, obviously there's a high upfront spend on marketing to get brand awareness for non-US companies entering the US market. How we treat those initial losses are also going to be under scrutiny when it comes from a tax authority perspective. Should those costs be borne by the local US entity, or should it be going back to the headquarter? And so there's a lot of decisions that are made that needs to be made right at the start of the expansion that will have a very significant midterm to long-term impact on where your profits are going to be. And that needs to obviously coincide with overall tax structure. And obviously, as Daisy will know, obviously there's some international tax considerations alongside the transfer pricing, which are important. So and then again, with respect to this specific industry, also some of the analysis that we perform here isn't straightforward. And as noted, with these four key areas of types of transactions, sometimes we have to employ a little bit more complex analysis to get to the right answer. In this, many times we do look at the profit split because we may end up with a situation where instead of the US being what we would call a routine service provider or distributor or anything like that, from a transfer pricing perspective, that they are themselves a principal in the transaction, entrepreneurial, and you might get into a situation when we have two entities that obviously both own significant intellectual property. And so our job as a transfer pricing team is to kind of think through what is the fair split of profits. So any upfront work on this and understanding how you're going to expand into the US and what the ramp up in revenues and profits is going to look like, we can help model the what your taxable income would likely look like once we've gone through each individual transaction. So I think we'll move on to the next slide, please, Nestle. And so I think one really interesting area here, and Ilya's going to expand on some of the state income tax items, is many times when we're talking about transfer pricing, we're thinking through federal transfer pricing. So US versus UK, US versus Germany, US, but there's an added layer of complexity to navigate in the US, and we spend a lot of time with our non-US clients coming into the US to kind of think through some of the state TP. And so many times state TP isn't scrutinized on a in the same way as federal, although there has been a move in recent years to really increase scrutiny of state transfer pricing. And I think when it comes to the gaming industry itself, because of the unique regulatory aspects and the need to kind of set up entities in each state, it's an issue that's higher on the radar. And now, obviously, given it's a newer area, we don't see, lots of, significant audit activity with respect to transfer pricing yet, but we can foresee, obviously, a focus area with respect to transfer pricing from state to state. And, indeed, I think it was last Tuesday, as an example, and something to kind of think about when we're talking about state transfer pricing. Last Tuesday, the state of Louisiana sued it's obviously public information, ConocoPhillips for, I think, close to $400 million US dollars, and which is a big number for several years. And I think it was 2008 to 2011. But I think the key point to take away when you think about state transfer pricing is some of the approaches taken are somewhat crude in a way, right, in terms of how they approach it. So, when we're dealing with the IRS or non-US tax authorities like HMRC, obviously the transfer pricing teams are very sophisticated and have a lot of experience with respect to looking at each of those individual topics we touched on the last slide and knowing how to approach them, how they're typically priced. When you get to the state, tax authorities, they have limited resources with respect to transfer pricing expertise. So many times they may engage an outside consultant, and we've seen this before across many sectors. With respect to this ConocoPhillips example, if you look at the document that came out last week, the analysis was in many ways very simplified. It basically stated, in Louisiana, over these years, you've been operating at a minus 4% or a one, minus 4% to 1% operating margin. And then it pointed to the consolidated profit of the whole group was 7 to 11% of operating profit, and an industry average of 7. And that adjustment, which I think for all years was coming up to 390 million, nearly 400 million. It was as simple as that. It was basically trying to calculate the change and how to bring it to profitability, totally disregarding a lot of the individual analysis that you would need to do by transaction basis to get to the right answer. And so, our recommendation here when it comes to expansion into the US with respect to domestic transfer prices, just to make sure that you put down, hey, this is all my transfer pricing transactions. I've looked at them individually. Here's the arm's length support. As noted in this, map on the right-hand side, many of the states do obviously follow the 482, the federal rules for transfer pricing, so we can use that as a guideline. And so and this is how we're working with Paul and Daisy's team. Obviously, we're thinking about both the federal items on the US side, but spending more effort and expanding that to a state-by-state analysis as well, just to show that we are at arm's length there. That particular audit in Louisiana goes back to 2008 to 2011. So any upfront work that you can do around the transfer pricing obviously would be beneficial in the years to come, so we don't get any surprises, because obviously that's the other thing about the gaming industry in the US. Obviously, lots of clients and companies are expecting significantly high profits, and so given the industry it is, given the high profit nature, there's obviously going to be a lot of scrutiny here. So I'm going to close out on this and now pass over to Daisy for some international tax items.
Thanks, Patrick, and hello, everyone. I'm conscious the focus of today's session is on US tax, and on that note, we're really lucky to have Ben, Patrick, and Ilya with us. But I'm jumping in just briefly from a wider international tax perspective, because I'm conscious that a number of our audience will be from multinational groups that are headquartered in the UK or Europe, and keeping that in mind for those businesses, it's not just about thinking, the US taxes in the isolation of the US operations, it's also thinking about how that then fits in with the wider group structure and tax profile. So on that note, I'm just touching upon a few key headlines for what we see as being some of those key challenges for multinational groups expanding into the US. And these are relevant irrespective of whether you're B2C or on the B2B side. The first one I wanted to pick up on is withholding tax, particularly in the context of profit repatriation. So the expectation from a regulatory perspective is that US activity should be housed in a US entity, which means your US profits will then build up in that US entity. And that raises the question of how do you get those profits back or repatriated to your headquarter jurisdiction somewhere else, and are you going to suffer US withholding tax on that repatriation? US withholding tax applies at a fairly high rate of 30% on certain cross-border payments. Those include dividends and also royalties, so any license fees for IP. The US has double tax treaties, which can provide a means of bringing down that 30% withholding tax. But unhelpfully, a lot of the jurisdictions that we commonly see in the sector for regulatory and other purposes, such as Gibraltar, Guernsey, Isle of Man, they don't have double tax treaties with the US. So, that 30% rate is very much there and as a problem. Malta does helpfully have a treaty with the US, but it doesn't go as far as to bringing that withholding tax down to zero. So when we're talking about getting profits out of the US, there is a very real risk of a cash tax leakage. And also where there are treaty benefits, I think just a word of warning is that to be able to access treaty benefits, US domestic legislation and also the treaties themselves are underpinned by anti-treaty shopping provisions. So it's not always automatically that easy to get those benefits. In terms of what we would suggest in tackling some of the withholding tax risks, really important to give upfront consideration to a holding company structure and also an IP structure, which kind of feeds back into what Patrick was saying about looking at a group's IP model. And then moving on to the next item we wanted to pick up on, it's quite a simple point, but I think an important one, effective tax rate. So commonly for multinational groups in the sector, effective tax rates can be relatively low, particularly where it's possible to support profits being recognised in Malta, where there's the effective 5% tax rate, or Gibraltar, where there's a 12.5% tax rate at the moment. Where activities expand in the US and there's growth, there's the natural expectation that your effective tax rate will increase because there will be profits recognized and subject to tax in the US. The US federal rate is 21%. There's also the overlay of state income taxes, which then brings it to typically a higher rate, and that will particularly over time increase the effective tax rate of a group, which, as we know, can have implications for any tax accounting, tax reporting. For listed groups, it can impact distributable profits and earnings per share. We also see this being relevant for businesses that put a lot of emphasis on forecasting. In terms of effective tax rate management, I think this feeds in a lot to what Patrick was saying about giving, good consideration to transfer pricing and the importance of looking at your US operations and those key transactions with other parts of the group. And then the final area I wanted to touch upon was how your US operations might be managed and what that means from an international tax perspective. So will your US operations be managed from the US, or will they be managed in other jurisdictions? We often see a lot of kind of global management roles at the moment. And if, for example, the management for the US activities are based in the UK or Malta or somewhere else outside of the US, tax risks around that can include whether those management activities outside of the US give rise to tax residence outside of the US or a permanent establishment for tax purposes. And in terms of tackling this, we just really encourage upfront consideration of what that management structure looks like. Obviously, the extent of any tax residence risks really depend on the specific facts and circumstances, and something to work through. So that's as much as I wanted to pick up on the wider international profile. And I'll now pass on to Ilya, who's talking us through a variety of state and local taxes.
Thank you very much, Daisy. And I'd say that's exactly right. When you start thinking about state and local tax, or as we like to call it, SALT, in the US, there's a wide variety of taxes to be concerned about and thinking about. And good news, probably that's why my colleagues went first and they let me go towards the end, because there's a lot to cover. That's kind of the bad news aspect of this. Can we move on to the next slide, please? Okay, so here are the flavors of state and local tax that companies doing business in the US or coming to do business in the US should be concerned about. And as you can see on this list, there's clearly not a shortage of state and local taxes to be concerned about. We got 50 states plus District of Columbia. And for the most part, all of them have income tax, sales tax, excise type tax that's applicable. And the reason why this is important to you, if you're working in this industry, it's highly regulated. States really know that you are in the state doing business, either because you have to get a license or you have to register with the state before you can do anything. So they are aware that you're there. And over time, obviously, they're going to check if you're compliant on the state and local tax front. Income taxes, franchise taxes, taxes that are based on gross receipts. There are several states that impose that in lieu of income taxes or together with income taxes. Delaware has a gross receipts tax, but they also have an income tax. Ohio has a gross receipts tax called commercial activity tax. There are also local income and gross receipts taxes that are administered in addition to state taxes. City of Philadelphia has its own tax called business income and receipts tax that has two components to it: income tax and receipts tax on one return. New York City is also a similar jurisdiction that has an income tax. Then you have to be concerned about indirect taxes, such as sales and use tax. And then again, there's a counterpart to the state tax. There's some states, some jurisdictions that impose a sales tax on transactions. Like Denver, for instance, imposes sales tax on sales of SaaS type products. Chicago, it has a tax called personal property lease transaction tax that often feels like sales tax, and it also imposes tax on web hosting or software as a service type services. Then there are state-specific excise taxes applicable to this industry, real estate taxes, commercial taxes on rentals. There's a couple states that impose tax if you lease property within a certain area in that state. Florida has one. There is a tax in New York City on commercial rent properties if it's located within a specific portion of Manhattan and is over a certain amount. Something to keep in mind of. There's some states that impose taxes on personal property, and that's business property used in provision of services. So if you have an office and you have desks, computers, etc., those are considered to be business assets used in business, and they're subject to this annual personal property tax. And then two other items that it's important to keep in mind of: unclaimed property, and we'll dive in a little bit more into that later. It's not a tax, but it's an obligation of making sure that any property that's actually property of somebody else, let's say a gaming account, if it's not used or taking into income by that individual, or that property is left unpossessed over some time, it becomes dormant property and needs to be reported to the state. Talk about that a little bit more. And then credits and incentives. That's another area to keep in mind, because when you move to the US, you might make some promises to a jurisdiction in order to get some incentives from that place, let's say reductions on income tax or sales tax, and then keep in mind that you're meeting those obligations year to year to year. And if compliance is not being met, then there's certain clawbacks to keep in mind, and we'll talk about that a little bit more. So let's start with income and franchise taxes. Next slide, please. I'd say that the basic level of starting your compliance with income, franchise, and gross receipts tax is to think about, where do you have nexus? Sometimes that answer is quite easy. Look, I have people in the state, I have physical nexus, I have office in the state, servers. That gives you physical nexus, which means that you have enough connection with that state that you have to be concerned about filing an income tax return. Sometimes this becomes a little bit more blurred. You might not have anybody in the state, but you have enough activity in that state through sales where it reaches a certain threshold. Let's say the bright line nexus states, and they can range from $100,000 of sales, like New Jersey now has this law for corporate net income taxes. If you have $100K of sales sourced in New Jersey, then you have economic nexus. And some states have that threshold even lower. Some say any sales into that state is enough to create economic nexus. Minnesota is one of them, for instance. And other ones might have a higher standard. Like California's $500K that started in 2011, now adjusted for inflation, it's, I believe, around 700, if not more. So there's different ways to create nexus, either physical or economic. One area that we find often through reviewing agreements is that an entity that's not domiciled in the US, a foreign entity, is contracting with a domestic entity for some services. This way you can create what's called an agency type nexus, where a domestic entity would be performing type of service for the foreign entity, and in effect would be working as its agent, and that can bring in the foreign entity into a filing group in the US. So it's one interesting concept to think about, that look, you might think the foreign entity has nothing to do with the US except for providing some basic type of service or vice versa, and all of a sudden they might create nexus by working as an agent for the foreign entity. So something to keep in mind, and making sure that in the agreements that's not being, whatever is being described does not create that agency type nexus for the foreign entity that you want to keep away from state filings. So once you realize that, look, I might have nexus with the state, what's the next step? The next step is to understanding what type of filing you need to do. How do you file? What's in the base of the return? And there are different ways states require filings. There are separate company states like Pennsylvania, where you just file a single entity return. There are different types of states which require a reporting on a combined basis. They require multi-state corporation to add together profits of all of its subs, regardless of their location, into one report. And a good example of that is California, New Jersey, New York is a combined state, Massachusetts combined state. For the most part, combined state have this provision where they keep all the foreign entities away from the water's edge of the US. We call the water's edge rule, outside of the report, unless foreign entity has some type of activity in the US that would justify bringing them in the combined group. And you can only imagine what that means for your filing, right? You might be bringing in additional base into the US that's going to be taxed in the state. There's this concept called of 80-20 companies. And this rule means that if a foreign entity outside of the water's edge, let's say UK-based company or another European company, has enough activity in the US, for instance, more than 20% of its sales are in the US, sourced to the US, then it could be deemed to be inside this combined group and should be filing with the group in the state return. Another concept that states have developed over the last couple of years, and there was a big move towards this concept at, say, 2015 through 2017, then it kind of died off. But then when you read proposed legislation, it pops up from time to time. It's this concept called tax haven. And what this means is that a state would target a specific company that's affiliated in a foreign jurisdictions, and they'll say, well, this country we think is a tax haven. We believe it should be that whatever that entity is located in the tax haven, it should be part of the combined group. The end of the analysis. So you have to look at where's the affiliate entity is located, and if it's within that jurisdiction, then you have to consider, should that be part of the combined group or not. One of the other items that it's always at the hand of state regulators is the discretionary power. States started to use this power a lot more often over the last couple of years. And the way they do it, they will look at what's filed and what they believe should be filed and paid in tax to ensure that it properly represents companies' activity in the state. So this is a direct attack could be a direct attack on transfer pricing agreements, direct attack on corporate planning, where the director of tax of a particular state might come in and look at what's going on, understand the full picture, and say, I don't think there's economic substance for what's going on. Let me review the agreements, and then let me rephrase how I believe the transaction and the report should be structured in order to accurately represent companies' tax filing based on its activities in a state. Often, just to tack on to what Patrick was talking about in transfer pricing items, states, of course, don't have as robust power as many accounting firms and law firms around the world when it comes to transfer pricing, the same type of experts. So they often rely on third-party expertise that might be working on a contingency basis. Sometimes they don't, sometimes they do, which then create their expert reports to opine against what the predetermined transfer pricing study might say. If there isn't one, then you have to then states say, well, look at this, we've done our work, where's yours? Which creates for controversy from the get-go. In addition to state income, franchise, and gross receipts taxes, the second area of taxes that you should be really paying attention to are indirect taxes, which are described more on the next slide. Of course, you have to keep in mind nexus concepts when it comes to sales tax. Can we go to the next slide, please? And again, in the US, you can have physical nexus and economic nexus. And after the Wayfair case, economic nexus can be reached if you have over 100K of sales or 200 separate transactions in a state. I mean, the rules vary a little bit, but the general rule is if you have 100K or of sales into a state or 200 transactions, that you should be kind of thinking about, do I have or do I not have economic nexus in the state? And then we can get into particular details as to how that $100,000 of transactions is measured in a particular state. There are common offerings that are particular to this industry that are subject to sales tax. What's fascinating about sales tax and state tax in general is that states do not, in some ways they like uniformity, but they like to have little twists and turns, and which you find out that there's not a lot of uniformity, and that each state needs to be analyzed separately from an income, sales, and use tax perspective. For instance, software as a service, which may be part of the platform, is subject to tax in about 22 to 25 states. Information services, infrastructure as a service or managed service is also subject to tax, but considerably in the less amount of jurisdictions. Data processing services, for instance, all the information about the betting that might be processed between the operator and the vendor, that may be subject to tax in a couple of states. Electronically downloaded software is subject to tax in 35, I believe, or more states at this time. Maintenance really depends on if it's mandatory or optional, and that guides the taxation. And security monitoring can also be subject to tax, sales tax, in about a dozen or so more states. And states like to take that definition of what might be, I'd say, a security monitoring service where a bank is being monitored against thieves, and then apply that broadly to the gaming industry, which we've seen based on our informal conversations with some of the regulators. Certain considerations to keep in mind which may affect taxability are what we call the bundling rules. The bundling rules in its basics are how you display products and services on an invoice. So for instance, tangible personal properties is generally taxable in most states unless it's a particular item that's exempt by statute or regulation. If service, which generally is not subject to sales tax in majority of states unless it's specifically enumerated, is attached and bundled in a single sum transaction, well, guess what? The whole thing becomes taxable unless you have good documentation on the back end to prove out, well, this part is this, that part is that, and there's a certain percentage of what is taxable and what is not to make the transaction non-taxable. But generally, and especially in audit, we see if an invoice says we have X, Y, and Z, and it has both tangible personal property that's taxable and a non-taxable service, the whole thing becomes taxable. True object of the transaction is a very important concept, and it's what it goes to is, let's say in this bundle situation, what's being sold, what's the essence of the transaction? Is it a taxable good or is it non-taxable service? If it's separately stated, well, that's easy, right? You can break out tangible personal property versus software, let's say like software, or it's a service, then it's separate, it's easy to see. But if it's all bundled together, then you get into this true object, what's being truly sold here, non-taxable service or tangible personal property that's subject to tax. The third point here, the intercompany services and transactions agreements, that's where we really can help you understand what's within these agreements will cause a risk for you, either as a purchaser or as a seller, and what transactions may be subject to tax in a particular state. There's some planning opportunities here as well, breaking out the transactions, right? Specifying, unbundling them, and also thinking about, well, am I selling a license to use a product like software, or am I selling an opportunity for the company to have access to my intellectual property, trademarks, etc., which generally are not subject to tax, right? So you gotta separate the two, maybe have two agreements or more in order to have a beneficial sales and use tax position. I think we talked about local taxes. Be aware of them. They can catch up with you pretty quickly if you're not paying attention to very state-specific and local jurisdiction rules. Registrations, that's another area that needs to be kept in mind when you begin to do business in the US. Sometimes registering with the Secretary of State means different things than registering with Department of Revenue for sales tax. And sometimes on the income tax side, if you register with Secretary of State, they consider that to be, I'd say, almost an admission that you're doing business in a state, and that will require you to file an income tax return. And if you don't, then state will assess a certain amount of money that they think you owe, and if you don't respond to enough notices, I'd say the contemplated amount of what they think you owe becomes real with judgment and a lien, and that's pretty hard to get rid of. Plus, since you're in a regulated industry, you may be kind of on the hook, and folks will look at this much more closer than any other type of taxpayer, right? They'll be, oh, this company is doing business here. They're subject to this. They are registered with Secretary of State. How come they're not filing? And then realize that you're in the regulated industry and treat this with more caution than just in general. And then the last item here on the slide to think about is the documentation of exempt sales. We have similar to we have this concept where if you buy something and it's resold, right, it's a sale for resale, it should not be subject to sales tax, because the tax should be paid by the ultimate user, the ultimate consumer. But in order to have a documented exempt transaction, you've got to have documentation in place contemporaneously with the sale or shortly thereafter, and states have different rules on that. And if you don't have the exemption in place, then on audit, a state may view that transaction as taxable, even though in reality it was exempt. So keeping documentation that's contemporaneous with the transaction, that is properly filled out in the correct exemption certificate form, is key. And then that form is updated from time to time, as states have different rules of what they consider as current exemption cert, or it's a stale one. And some states say, look, you gotta refresh these ever so often. The next item to keep in mind is the flip side of sales tax is use tax. Can we please go to the next slide? So with use tax, the purchaser needs to be concerned if they're buying something that should have been subject to sales tax, but they were not charged sales tax. And with rules around software, they're fairly complex, right? Somebody might be buying something that's not that expensive, maybe from one transaction, but then over time becomes significant. So you want to keep in mind that if you're not being charged sales tax, why is that? And if the transaction itself taxable, then the company may be subject to self-accrual rules, where you have to figure out what you should have paid in sales tax, and then remit that use tax to the state for your right to use the product in the state. The rates vary among states, which makes this complex. Another area where this happens is, for instance, the purchaser bill to location might be in one state, but then the software product is used in a different state with a different rate. And even if the initial bill to rate was the sales tax on the bill to rate was paid and it was a correct amount, the other state will say, well, you used it in my state and we have a different rate, which is higher. You owe us the difference. That type of analysis is important to do in making sure that the use tax is paid. And if it's not paid, over time, if those returns are not filed, statute never begins and liability can go many, many years back. Often, and there's a dozen or so states that require for the seller to be registered in a state in order for the company to be registered in the state in order to give an exempt certificate, right? So be careful with that as well, because if somebody's not registered in the state and they give you an exemption certificate, well, guess what? They should have charged you sales tax. It should have been due, but for this mistake. So it's important to keep that in mind. Registration issues are starting to come up a lot more often than audit, because it's I'd say more of like an administrative gotcha. And if you're not doing this every day, it's easy to miss. I want to end talking about unclaimed property, which is the next topic for us to think about. And this might be a foreign concept to a lot of inbound companies. This type of tax might not exist in your country, but in the US, it's becoming, and it's not a tax, it's an obligation. It's becoming more prevalent, and another way for states to collect revenues, because it's such a unique and nuanced obligation that it's not conceptually recognizable even within companies within the US. So you might ask, well, what is unclaimed property? Well, unclaimed property is generally a fixed certain interest in intangible property that is held or issued or owned in the course of holder's business that has gone unclaimed for a specific period of time. And that period of time is called the dormancy period by a rightful owner. So in this picture, you might see folks playing, looks like they're playing blackjack or craps, what have you. And you can do the same thing on the phone now, right? And let's say if you place a bet and over time, you just forget about this app. For instance, if I start doing this and my wife says, well, Elia, what are you doing? Stop doing that. And I say, okay, I'll put it aside and never access this account again. And I have winnings. Well, over time, now states becoming more aware of this and changing their regulations and statutes to include sports wagering, betting accounts, game-related digital content, virtual currency, funds on the game within the definition of what's considered unclaimed property. If the dormancy period passes, which can be 3 to 5 years, sometimes shorter, 1 year I've seen, well, that means that the money on that account should be either given back to me. And if you try to connect with me and say, Ilya, we have this for you, and then I'm unresponsive, over time, the obligation becomes that you need to remit that money to the state. And the state is the place of the company's incorporation, which is often in Delaware. So the challenge here comes with, first of all, understanding these laws. They're pretty complex. They have varying definition of what is unclaimed property. Generally, it's usually bank accounts, stocks, mutual funds, right? But when it comes to this industry, the laws in many states are still being proposed and written, and the ones that are written are broadly defined. So a lot of things may be considered unclaimed property. Then dormancy periods vary, right? How do you measure when was the last time contact? When was the money or credit won on the account? And then the reporting methods also vary by state. So reports in some circumstances must be filed to the state if the value of the property can be as low as $25. Some states do not even have minimum reporting requirements. Like Connecticut does not, Delaware, I think New Jersey and Pennsylvania do not have a low threshold, just have no minimum reporting standard. And you might ask, well, okay, we just maybe started doing business in the US, maybe for the last year or two. Maybe dormancy periods are not kicking in yet. What should I do? And what's the interest? What's the interest and penalties that I might be looking at? So I did some research last night to understand, is this super catastrophic or not? And I think it might be depending on a state and your particular situation. But in general, what I noticed that annual interest on unreported funds and unreported obligations to the state can be as high as 10%, sometimes 12%. Delaware is a pretty aggressive state. They say that annual interest can range from 0.5% per month, and it goes all the way up to 50% cumulative. New Jersey, I think, is 10%. Pennsylvania, so is 12%. Penalties are also different. There's two different types of penalties you can have in this realm. One is for failure to file and withhold on the report, and the other one is failure to deliver property to the state. And failure to file and withhold can, in some instances, get fairly expensive too. In New Jersey, it goes up to $100,000. The penalty could be $200 for each day the report of payment and delivery is withheld and not given to the state, and it goes all the way up to $100K. Pennsylvania might be a little bit better result. Could be up to $1,000 for one failure, and can be not more than $10,000 overall. But if intentionally some funds are not being reported to the state, then other but more severe penalties may be incurred, some of them on the criminal side as well. So that's something to keep in mind. Many states over the last 2 years, actually 3 to 4 years, began cracking down on the claim property. Before, it was Delaware was known as the state because many companies are incorporated there. And for Delaware, this is one of their, I think, top 3 or 4 revenue raisers for the state. But other states have started to look at this as well. And they try to enforce compliance either through examination, audits, sending out VDA letters, voluntary disclosure agreement letters, as well as hiring third parties to do the audits. So if you ask what can I do now about unclaimed property, I'd say there's 2 things. One is think about what is the process and procedure within your organization. Is this on a radar or is it not? If it's not, I would suggest put this on a radar. Let's review it. Let's make sure that you comply with unclaimed property rules, and then you have a process in place to track what is the unclaimed property that you have in a particular state, right? What's the dormancy period and what you need to do. And if you receive a notice, a VDA, invitation to do a voluntary disclosure agreement or an audit, let's talk and make sure that you are in the right path to becoming compliant and that you don't fall into one of the situations where just audits get out of hand, all this information is being asked, and you just don't know what to do. We have the right people in place to help you out with that. All right, let's see what's on the next slide. Key takeaways.
Brilliant. Well, thank you very much, Ilya, and thank you to all of our presenters as well. I've just mindful of time. As I've been hearing that, one word keeps on repeating for me, which is complexity. There is an enormous amount of complexity, I think, to navigate with the US. And could we go to the next slide, please? And perhaps as our speakers wrap up, and I'll ask them an impossible question. If you could just finish up in one sentence, what would the key takeaway be for and what you'd recommend to our audience today?
Sure. I would say make sure that you have a good gaming counsel in each state that you want to do business in, because they have the experience to help guide you through the regulatory process and many of the tax issues as well.
Yeah. And then on the TP side, upfront planning is going to pay dividends, both from risk management, but also achieving, making sure you get your profits in the right location and the cash in the right location.
And for me, for the multinational groups, not just looking at US taxes in isolation, thinking about US tax in a holistic context with your wider group tax profile.
Okay, brilliant. Thank you. That's very good advice. So we have had a couple of questions, but given the time, I suggest that we follow up individually with the people who have asked that. So I'll just finish then by saying a huge thank you to all of our speakers today. Really great, in-depth, really accomplished sort of talking through some of the issues. And thank you to everyone listening in as well. And of course, we'd be delighted to carry on the conversations with you individually. Okay, with that, we will close. Thank you all, and I hope to see you soon.